Bear with me a minute. Hey, do y'all hear the music? Let me know in the comments if y'all hear the music. I'm just curious. They made some changes to the system, and I'm still not used to them. I'll get used to them. But they changed the whole thing. So, good morning, everybody. It's Hammer. Today is Tuesday, April 8th, 2025. I, of course, am here with your daily mortgage rate update. The only place on the web where you guys get to join me live each and every weekday morning, 9:30 a.m. Eastern Time, coming to you, talking about what's going on with rates and pricing. Sean Segaloff says, yep, he hears the music. Taylor Henry, y'all heard it too. Good. All right, good. So, I know that originally it said Monday because when I put that, anyway, they changed things. So anyway, good morning, y'all. If you're here this morning, say good morning. Remember, you can join me live. I love all of you that do join me live. Thank you for being here. We're going to talk about what's going on with rates and pricing this morning. Huge jump in rates yesterday. How many of you saw 3 reprices worse? UWM. Three reprices worse yesterday. I warned we were going to see volatility. I could probably go through the email and show it. Last week when we got the tariffs, I said, hey, expect volatility. But yesterday when we were doing the live, I did not expect the craziness that we saw. So we're going to talk about what caused that, what we saw yesterday, why your rate sheets jumped, and most importantly, are they going to come back? So we're going to go into that in a little bit more this morning. If you're watching the replay, don't forget, give me a hashtag replay in the comments. Let me know that you were here. If you are on Facebook, don't forget to smash that like button, tag an LO friend, share this post in a group. If you are on YouTube, do me a favor, click that thumbs up and leave a comment. Comments help. Act like you're here live. Say good morning. Let me know if you got a bunch of reprices worse. Of course, make sure you do give me at least a hashtag replay. What happens is, on YouTube, I see that there's like 50, 60, 70 views on these videos, but I can't tell if people are really watching them or not. So let me know if you're watching this on YouTube on the replay. The live comments are actually separate than the replay comments on YouTube. So I got to start paying more attention to how that works there. Anyway, if you would like a reminder that I'm going live each day, you can get a reminder to your phone, get a text with the links, www.hmmr.io. That's our Hammer Solutions short code, and hmmr.io/reminder. hmmr.io/reminder, and or use this cool QR code. If you're on your phone now, take a screenshot. You can actually go into your photos and use that, which I think is the coolest thing ever, that it does that. So let's go ahead and say hi to the live folks. Who do we have here this morning? Let's see. Good morning, Mr. Mike Tebow. Great to have you here. Megan Lindbergh, great to see you. Ron Siegel, good morning, sir. Today is National Empanada Day. There's something to celebrate, a lot more than the rates and pricing, right? Michael Love, good morning. Taylor Henry, good morning, sir. Amy Blauser, great to see you. Angela Walters, good morning. Megan Lindbergh, great to have you here. Sean Segaloff, Brandy Brickler, great to see y'all. Taylor Henry, Yasmin Martin. Brandy, where were you traveling to? I saw you had a crazy travel experience. Was that recently? Sometimes Facebook shows me posts that are so old. Good morning, Yasmin Martin. Mike Tebow, Angela Walters, Tom Stafford, dancing. He loving that chill music. Mike Morano, good morning, sir. Man, I'll tell you, it is some crazy stuff going on, man. Taylor Henry, he said he saw 3 as well. Brandy Brickler, she's showing 3 hand palms because it was so bad. Rob Stewart, good morning, sir. Josh Osborne, Mike Schmolgan. Anybody I missed, please know I'm glad to have you here. So, all right. With that said, let me go over to the captions. I don't have anything all broken down. Let me just bring up the screens and kind of go over what happened. So yesterday, let's see, share. All right. So taking a look here yesterday, let's start out, I guess, with where rate sheet, rates and pricing went, right? So we saw basically, I mean, they're showing a quarter point jump here, basically. And that's what many of you saw, is a quarter point jump in price in rate. We were at some of the best levels of the year, right? 6.60. And then boom, it bounced from Friday to Monday. And we saw this. Now, let's look at mortgage bonds. You can ignore this giant line here. They had some kind of a glitch and they haven't cleaned that up. But this giant red candlestick here, that's legit. Let's go ahead and do advanced charts. Let's click on this and get to an actual chart. So we're still following the 5.5 coupon. You could see that here, right? But as we take a look yesterday, you could see, let me go ahead and change this to an arrow. Okay. Don't I get like a bigger arrow or no? What if I do a dot? Yeah, the dot's okay, I guess. I like the arrow. All right. So let's go ahead and you can see here, this was Friday, this candlestick right here, right? We started out at the best level. Now, remember, these are mortgage backed securities. The higher these candlesticks go, they reach for the stars. The more they sell for, the better your rates, the better your pricing. Okay. When they come down and they lose ground and they sell for less, your rates get worse. Now, if we go back to September, let's go ahead and we'll draw a line here and then we'll move it a little bit. But let's go ahead and just draw a line here. Let's make that line yellow because who the heck can see blue, right? So let's pull that down. So this level here that you're seeing, this was our best. This was our best level that we saw in September. That's when we had rates that were in the low sixes. Govies were in the high fives. We were living the dream right there. And what happened was the tariffs. We saw the tariffs. They were announced on, trying to find the dates here. So the tariffs were announced on the 26th, right? And you could see that right when the tariffs were announced, we started to see things get better. No, they were announced last week, April 2nd. So I'm sorry. So anyway, as we were working our way into the tariffs, here is April 2nd. And then we saw improvement, but we'd really seen improvement before those tariffs hit. And that's but yet now we've seen everything drop down. So let me show you a couple different things. Yesterday, I may have to refresh this, but let's see. Nope. Okay, good. So yesterday, if we put this, let's put this in the 5 days so we can see perspective. So this was yesterday. This was the Friday. Okay. So on Thursday, things were calm and we ended the day calm. Friday morning, we started out with big gains, and it looked like we were going to see continued improvement. We thought we'd see more of a flight to safety and safe havens, and we started to lose ground on that as pricing was coming out, but it didn't look too bad. We saw some improvement. Then we went from being up on the day, we were positive on the day on Friday morning, and we lost ground and ended the day in negative territory on Friday. And that was a very, very big red flag. We were concerned about that. And when I sent out the text alert, I was concerned about that. And we talked about locking some loans. Then on Monday, yesterday, we had this huge barn burner. And what happened yesterday, we started out when we were doing the video yesterday morning. Look at this. We were at 100.33. I mean, that was right about where we were from the day before. We were like minus 3 or 4 basis points. Then we were at 0. Then we were at minus 10. But overall, it was really nothing after that. Look at it, 10 a.m. Boom. The bottoms just drops out, right? And things start to go nuts. And then we just see a huge sell-off. Why did we see this first drop here? Why did we go from 100.28 to 100? Why did we lose 30 basis points? Also, let's go ahead and look at the 10-year. Look at what the 10-year did at that same time. Right here, this is the 10-year. Again, it crept up on Friday. Wasn't too bad heading into yesterday. And then all of a sudden at 10 a.m., here it goes. It just jumps. It just skyrockets. And why did we see it jump 15 basis points in 15 minutes? We went from 4.03, 4.02 to 4.14, and then it kept going. Why did that happen? Well, that was because of the rumor. We saw the rumor that Trump was going to put a 90-day pause on tariffs. Now, markets had been waiting for that. They were expecting that. Let me just go ahead and move this for a minute. Okay. They had been waiting for that. They were expecting that, but it was just a rumor. And the White House came out and said, hey, that's fake news. And they actually used that term. They said it was fake news. Not an inaccurate report, nothing like that. They came out and said fake news because that's what they say. So anyway, we saw, let's go ahead and put this on 2-day for now on the 10-year. Remember, this is the 10-year, right? So we saw this huge spike. Okay, they came out, they say it's fake news. It starts to settle back. It doesn't come back down though. It just continues to rise through the day, rising, rising, rising. We started the day with the 10-year right around 4%, even dropped down a little bit, 3.98, below 4. Ended the day yesterday at 4.20. 4.19, 4.20. Now we're up 4.24. I'm going to go ahead and move this back to mortgage bonds. We're right here, 4.24. Look at this candlestick. It took days to see that yield drop, and it recovered here. Now I'm in the middle of writing the morning. I didn't get a chance to send it yet. I'm in the middle of writing my lock advice here. So let's kind of go through this and keep things solid. So first of all, if you are not signed up for our text alerts, you got caught off guard. We sent out an alert early yesterday that things were turning because we knew there's volatility. We knew that it was going to be the potential there. And we sent out an alert that we were, in a position to see reprices worse and that things were going to get bad. So if you're not signed up for our text alerts, why not? www.ratetextalerts.com. They're $7 a month. I don't want to hear that they're too expensive. You don't need to spend a lot of money to protect your pipeline. Even if you do one loan every 2 months, you should be signed up for these. Rate sheets today will be terribly worse than yesterday morning. Obviously, you know that, right? And we saw that here. When we look at pricing, you are basically a quarter point higher. Where does that put us? It puts us in the high side, higher than where we've seen basically, and except for the end of March, 327. So that was our worst things. And now we're right back up there and we're getting worse. This morning, this was the end of the day yesterday. This morning, we're going to be even worse because mortgage bonds are down 13 basis points already this morning. They're continuing to worsen. So rate sheet today going to be terribly worse. Reprice risk on the day is moderate. It could be worse than that today. Yesterday was a brutal day for rates. So some lenders are repricing not just once or even twice, but 3 times. I warned in the morning commentary we could see bonds worsen and rates creep higher, but I had no idea we were going to see the total meltdown that we got. There was an excerpt from Bloomberg, and I'll show you here. So basically, this is a really great article from Bloomberg. Ron said the big jump was the false report on Reuters about the tariff pause. Yeah. So and then but did it come back is the question, right? So yes, Treasuries yields on 10-year fell 3 basis points to 4.16, which again, what are they at right now? They are at 4.24. 4.24. Huge difference already, even today. So the relative lull came as a relief to traders after a fraught day of trading in the U.S. with little clarity on whether President Donald Trump is willing to offer relief on his tariffs. A gauge of Treasury's implied volatility has soared to its most extreme level since October 2023. This is a gauge that they use for the volatility of Treasury, similar to the VIX gauge for stocks. Currency fluctuations are at the highest in 2 years. The VIX index of equity volatility has hit an 8-month high. This shows you that nobody knows what's going on. If anybody claims that they know what's going on, then they're a lot smarter than me, if they really do. Traders threw out a number of possible reasons for Monday's whiplash. Again, this is specifically for bonds, what we saw. A market primed for a pullback after such a sharp rally. Lurking concerns about tariffs stirring inflation or necessitating government stimulus. Right now, stock markets, equities, traders, there's all these headlines that we're going to see 5 rate cuts in 2025 from the Fed, or that we are going to see an emergency meeting. That's bullshit. That's utter bullshit. The Fed is not going to intervene because stocks are tanking. The economy is not tanking. Stocks are tanking. They're not going to step in. They're not going to, this is a breakdown in equity markets. It is going to hit the economy, but it's not something that they're going to step in and fix. Also, the Fed's normal tools not going to work on this kind of inflation, right? It could play a role. But remember, when you have inflation, when you have the cost of goods go up, what were the reasons we saw that? Well, during the pandemic, after the pandemic, we saw that there was broken supply chains. There was more demand than there was supply. People had a lot of pent-up money. They had a lot of pent-up demand. People were taking trips. People were getting outdoors. Again, I don't want to get too much, but I am bitter and I'm still angry about how the pandemic was handled. So, but people they had a lot of extra money. We had all that ridiculous unemployment money. We had PPP money, payroll protection program money. You had stimulus from the government, people getting checks. You had all this ridiculous amount of money. You had supply chain issues. That was inflation. The Fed can fight that by raising rates, making it more expensive to borrow, trying to slow down the economy. The inflation that we're looking at now is because you would have companies passing on the cost of tariffs into the price of goods. You're not going to slow that inflation down. If this costs me, I don't have my drink today to show you, but here you go. I got some turmeric from here. So here you go. If this turmeric cost $10 this bottle, and now we've got 25% tariffs, and the company decides to pass along all of it, and they say this is going to be $12.50. That's inflation. Guess what? If the Fed raises the Fed funds rate or keeps it the same, it's not going to change that. It's not going to change this. It's not wage inflation. It's not services inflation. It's not consumer inflation. This is passing along those tariffs. So all of this is so broken. And what you're seeing right now, it's nuts. So markets are reacting. They're afraid of stagflation. They're afraid of inflation. I'm going to go back to this for a minute. This is really the thing. So after watching bonds plummet, when we see a day like yesterday, a face melter, a bond burner, right? It says, should we see a rebound today, right? Normally you see a rebound. You're not. No, wrong. And that's already playing out here. We're down 13 basis points on the day. We're seeing the 10-year treasury yield continue to go up. You're not seeing that reversal. And don't expect bonds or rate sheets to recover, not with the complexity of what we're dealing with right now in markets. In fact, both the 10-year moved higher and mortgage bond pricing moved lower this morning, both bad for rates. Here's why. Treasuries and mortgage bonds no longer the safe haven play. Bill Stevens said no flight to quality safety. Investors going to cash or gold. Cash or gold, also foreign bonds, foreign stuff right now. Also foreign, when I'm going to oversimplify this. I don't know off the top of my head to get super intricate. I'm not Barry Habib, right? Barry lives this stuff. He knows so much more than I do. Once I get outside of my realm of how this affects rates, it's not my strength. But basically, when you have foreign investors buying U.S. Treasuries, it's more expensive for them because they're usually insuring against the dollar and all these other things. It's a complexity to it, which raises that cost. So now you've got like German bonds that are giving a much better yield because Germany is part of Europe reacting to the fact that they're going to have to increase their war machine, which means a lot more borrowing, which means, increases the yields there. Japan's bonds have gone from 0 to like 1.25%. That may not sound like a big deal, but it is. You'll have them investing more of their money there. All of that stuff happening on that side. So no, Bill, there's a lot of questions. There's some articles now about, treasuries not being that pillar flight to safety. And in fact, we've got 3 treasury auctions this week. We got the 3-year today. We've got the 10-year and I think the 7-year. Hold on a minute. Let me make this smaller and let me make this full screen, and bear with me a minute. And we're going to go to the economic calendar here and take a look. So we've got the 3-year auction today, the 10-year auction tomorrow, and the 30-year auction on Thursday. So if there is a weak appetite for these, that's something that's going to come more of a play. We've got the FOMC meeting minutes coming out tomorrow. Markets will discount some of that because they think that the Fed is going to be forced to do things. Ron says, who wants in on the bet, not monetary, but drink? The Fed will have to cut in May, 25 basis points, 3 more after that. It is only inflation if one buys it. Credit defaults are going to slow purchases. Jobs will start to reflect slowdown. Fed will cut, not because of the stock market, but because of the economic slowdown. I don't think it's going to be in May. I don't think they're going to cut in May. And right now, expectations of a May cut, let me shrink this back down so we can see it all together. Right now, we're looking at the CME tool. Hold on, because I can't get to this side when I do that. Hold on, I'm getting there. It'll take me a minute, but I'll get it there. So this is the CME Fed Watch tool. Yesterday, there were expectations that we would see a May cut. That dropped. Let me see if it shows on here. Not as clearly. It was later in the day. It was almost 50-50 when we did the video. Remember, it was like a 40% expectation that we would see a rate cut, 60% that we wouldn't. That's almost disappeared. Markets don't believe we're going to see a rate cut in May. I don't think the Fed will have to cut in May. I think it's too soon. You're right. We have one more jobs data coming in before then, but I don't think they'll cut yet. I think that there's just too much going on and they'll hold back on it. If they cut, I think they'll go with a 50-point cut in June. Markets believe we'll see the first cut in June, and it'll probably be a quarter point cut. I think we'll see more of a chance that we could see another half point cut if the market shows weakness later on in June. By the end of the year, remember, we're at 4.25. So you're at 1, 2, 3, and 4 rate cuts. The 5th rate cut, much less of an expectation. Remember, yesterday, markets were betting on 5 rate cuts. So we've got 1, 2, 3 being the primary, 4 being a very close secondary rate cuts for the year. Bill Stevens asked, China selling treasuries impactful? Yeah, absolutely. Was it the cause or the whole thing? No. Was it impactful? Yes. China owns so much of our debt, they can manipulate markets, and they have every reason to right now because they're pissed off about the whole thing and where it's going. Randy said, what are the chances yesterday is just an overreaction? The market corrects. It was an overreaction, but it was also a correction. I highly doubt, Randy, that we're going to see any of a reversal here. That's what I've got on here. Here's why. Treasury and mortgage bonds are no longer the safe haven play. I'm not going to profess that I absolutely know what's happening and why. No one does. But I warned of volatility from the moment the tariffs were announced, and I expected this. I think traders have seen stocks lose so much, they're waiting for any reason to start jumping back in. They're going to be looking for opportunities, right? I think inflation and stagflation, remember, stagflation is when inflation rises, even though the economy slows down. They're going to be a bigger and bigger concern now. I think when we get that CPI data on Wednesday, it can't come in good enough to spur the idea that we're not going to see inflation. And if it does show inflation, if it ticks even a hair higher, you're going to see a huge negative reaction to that in bonds. I think any news of a deal, agreement, pause, also going to rally stocks and hurt bonds. I don't think there's any reason right now to expect a recovery. And when we go back and look at where rates are at, when we go here, again, we're only in the same area, the high point, kind of where we were before the tariff started, 6.78, 80, 81, 82. We're back up there, but I could see them creeping higher. If they come back down, they're going to come back down to these levels, not lower. For months, the last few weeks, I've talked about having those windows. Last week, I warned you it was a window. Have that conversation. Tell the consumer that that we don't want to try to catch a falling knife. Be ready to lock these things. Get those loans in because those rates are gonna disappear and they're gone. Just like that, boom, it's gone. Second time this year we've seen that happen. By the way, rates are here, boom, they're gone. We saw it happen last year. So this is going to continue to happen. You'll see reasons why we'll get these windows, but it's going to be there. Mike pointed out no one's lost money in the stock market unless you sell. That is true. And Randy said, how does yesterday affect the view of a coming recession and thus our medium-term rate outlook? The term recession, let's clarify, are we talking an economic slowdown or a true recession? If it's a true recession, what is the definition of a recession? Generally, you're looking at 2 quarters of negative GDP growth. So, let's just say, are we going to get a recession as in an economic slowdown? Yes, we're going to see an economic slowdown. Remember, a lot of what's being spent right now is credit. If we see a slowdown in credit, if credit risk goes up, if banks start panicking that there's a lot more risk of default, we're going to see a slowdown in credit, available credit, and that's going to really send things crashing. All of that stuff would help rates, but it's going to be more complex, especially with the idea that we could have stagflation, which is the economic slowdown that normally would lead to less spending, which brings the cost of goods down. Because if this Cunol company here isn't selling enough turmeric, what they're going to do is they're going to go ahead and start lowering the price. So the problem is if they're paying tariffs to bring this in, they're not going to lower the price anymore. In fact, they may raise the price. So you have rising prices, inflation, with a weakening economy because of what's going on, and that would break the idea of rates being able to improve on that. So that's kind of what that does as well. Ron said, economic slowdown. There's just a report. No evidence China's slowing bomb purchases. They're not selling. The economy is slowing, and they covertly want the safety of the U.S. economy. That's Ron's definitely a student of the game here, and China is doing a lot of economic stimulation to try to fight the tariffs and things like that. There's been a couple of sources, Ron, that are saying that they are selling. So I don't know if that's legit or not. And Mike Tebow's making fun of me talking about the windows. Someone broke my windows. So anyway, my friends, 26 minutes in, I really think we got to wrap this up. Lock everything. That's the bottom line. Lock everything until we know where this floor goes. Lock everything. Looking at technicals, it doesn't matter. You're going to see markets are freaking out so much right now. It doesn't matter what any of that. So, all right. I'm sorry to bring you the bad news. I think it could continue to get worse before it gets better, and that's where we're at. So, all right. Well. And then Ron pointed out that Apple's proving what he has been talking about, which is true. He talked about it with us. They're moving their production to India and Vietnam. Tariffs are punitive more than inflationary. Tariffs will further damage China's economy and not have the inflationary impact. Hopefully that is true. So, all right, my friends, I'm going to wrap it up. I'll see you guys tomorrow. Hopefully we've got something better to talk about, but we're going to be, leaning into, we've got the Fed meeting minutes tomorrow. We've got more, we'll talk about having today's treasury auction and just see kind of where today went. Reprice risk on the day is moderate, though. You want to lock all your loans, and we'll take it from there. All right, y'all. Hope you guys have a fantastic one. I'll see you tomorrow. Bye-bye.